Erik, you've just published your latest Credit Quarterly Outlook. What are your views on the current market environment and what it means for credit portfolios?
Yeah, I mean, we see an ideal scenario materializing for global credit markets. So we see an environment where inflation is moderating across the globe, but at the same time we see that, especially the US economy can avoid a recession. So a very good environment to capture the current attractive yields in global credit markets. We also would be a bit cautious in the sense that there are still alternative scenarios out there, and we think markets are priced for perfection. So in terms of potential volatility coming from US elections, or geopolitical volatility, or real estate, we think we need to be a bit cautious as well.
So having said all of that, how should credit portfolios be positioned in this environment?
Yeah, I mean, in this environment, we definitely want to focus on quality yield. So we emphasize high quality credits. We like European financials. We like bank debt. We think fundamentally the banking sector is quite strong. If you look at capital positions, liquidity ratios, we like valuations in bank debt. And we want to avoid parts of the market where have less allocation, where we are a bit more concerned. So US credit markets, Asian credit markets are in our view too expensive. So that is what we want to avoid, and also have a little bit of treasury exposure as a potential hedge against credit volatility.
Now, from a team perspective, how would you say you are best positioned to take advantage of these various opportunities in global credit markets?
Yeah, I mean, we have a well-resourced global credit team for the credit professionals, with deep knowledge on global credit markets. We launched our first global credit strategy already in 1997, with a good track across high yield, global investment grade and emerging credits. So the credit income strategy can benefit from this expertise, can be very flexible in its top-down asset allocation and really identifying parts of the market where we see opportunities, but also finding companies and sectors where we think markets will struggle, and actively also manage duration to make sure that you limit risks in a more volatile rate environment. So we think it's a very well set up strategy to benefit from that.
Tell us a little more about the SDG Credit Income strategy.
Yeah, I mean, the SDG Credit Income strategy is a flexible global strategy. We identify and invest in the best income opportunities across global credit markets. The strategy since inception has delivered high yield-like returns with less volatility than a standalone high yield investment. And that is also because of the quality bias. So we focus on the higher quality parts of the high yield market and of investment grade markets. We invest primarily in shorter dated credits. And we do actively the asset allocation, looking at the opportunities. We take our top-down outlook and then identify what are the best bottom-up opportunities in markets. And we focus very much on risk control. So I think this is a very nice way to provide quality income, quality yield, but in a risk-controlled way.
Well, Erik, thanks so much.
Thank you.
And if you'd like more information, please do visit the Robeco website.